RBC and Goldman Sachs are at it again. They believe the SP 500 will hit a record high in 2024, and this mostly has to do with bond yields retreating. But could bond yields be the reason markets actually start to pull back? With clear risks ahead as oil trades with extreme volatility and jobless claims coming in better than expected, today we talk about what happens if the consumer remains strong into 2024 and what that'll mean for interest rates. Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell. Let's get into it. Now, today was an absolutely fantastic day. There was great breadth across the board. Everything from technology to healthcare to real estate, financials, everything really caught a bid. And this was marked by fantastic breadth. 3,800 advances, 2,000 decliners. You have to put into perspective that most of it accounts for S&P 500 companies, which make up 70% plus of total earnings for the index. And look at the stocks above the 200 moving day average. We are getting to levels that we last saw in September and the July period. 52.8% of S&P 500 stocks are now above their 200-day moving average, which is the golden standard for bull markets. And the strong breadth came into a strong November. The index has gained 8.2% in November right now, and it has only done this 6 other times since 1928. And I put this stat on X here, guys. Go ahead and follow me on Twitter, or X as they're now calling it. This was the stat we put on. So this is the chart right here. We just hit 8.2% for the month of November, and even more now. This was before the open today. And we've only ever done this 6 other times. And in every single one of those days where we were 8.2% or greater on the 17th trading day, the only time we finished lower was in 1934. 6 wins, 1 loss. And what does that mean for 2023? Well, after today's price action, it looks like we're probably going to end the month higher, but there's still about 7 or 8 trading days left. We are chugging higher slowly but surely, and we've just moved 2 points further into greed. We were at 64 just yesterday. We are now at 66, and I do think that we are going to move into this extreme greed area, and this is why. This is the NASDAQ turkey wrap, which is just the Wednesday to Friday around Thanksgiving, and it has seen 30 wins, 0 losses, returning 1.03% on average in just the 3 days. And all the stat is, when you've had a positive trailing week, the returns that you can expect on Wednesday are 0.64% and 0.39% for a total return of about 1% on the Friday. Today we actually did return 0.49% in the NASDAQ, or around this area. So it seems like we are probably going to go 31 from 0, but let's not count our chickens too soon. Let's move on to oil. Guys, oil was extremely volatile. From the peak to trough in one day, fell 5% on some very crazy macro news, and then pared its gains into the end of the US trading session. And all of this came on the back of OPEC and Russia delaying their meeting. They pretty much moved their meeting they're supposed to have on Sunday to the week after, and that was because there were some disagreements among members about future production cuts. Long story short, OPEC countries need to cut production to decrease supply because the demand for oil right now is simply not there. Apart from maybe the US and Australia, the global economy is on shaky legs right now. And this is why these OPEC countries extended the meetings. I think they wanted to see what demand is going to look like after Thanksgiving before they make any definite decisions. But let's talk about treasuries. The yields in the longer end moved lower, higher in the shorter end, but it wasn't anything significant. It wasn't anything to go on. And we do know that based on Fed fund rate futures, we are expecting a 28% chance of a rate cut in March 2024, and possibly a 13 to 14% chance of a rate cut of 50 basis points in May, but a 50% chance of a 25 basis point cut in May as well. So sort of like this March-May area, this is when rate cuts are expected. And here are the stats, guys. So this is 12 months after the final rate hike, 6 months and 12 months, and the returns that you can expect. In the last 6 rate hiking cycles, we can see that the 6-month return 13% 6-month return, 17% 12-month return. Very positive stats. But what about rate cuts? Normally, there is a lag from when the Fed stops hiking to when they start cutting, and that lag is normally 6 to 12 months. But when the Fed start to cut rates, on average, 195 days later, you'll get about a 23.5% decline in the S&P 500. So this is how it normally goes. The Fed hikes rates, then they stop hiking rates for a while, and during this period right here, the S&P 500 normally increases 9 to 12% in this period on average. Then when they start cutting rates, this is when the S&P 500 decreases. And this is because markets are forward looking. When rate cuts are already happening currently, they were priced in about 9 to 12 months ago. What we actually are seeing right now is rate cuts in the global economy. And this is some data I have here, and this is total rate actions from 81 central banks across the globe. More cuts now than hikes for the first time since January 2021. These are hikes, these are cuts, and we're officially starting to see more cuts in global central banks. And this is just really telling in terms of the global picture, especially in, Europe, Asia, Africa are not faring too well, especially China. And while the global economy might be weak, according to US economic data, the US economy remains strong. Consumer sentiment numbers were released yesterday and it was good. The University of Michigan's Consumer Sentiment Index rose slightly last month, indicating that consumers remain positive despite a slowdown. Overall, the survey indicates that consumers, while still watchful, are nowhere near close to panic mode, and they should keep spending through the holiday season into Christmas. Despite that though, the inflation expectations are still under control. This report is still squarely in the sweet spot for continued growth into early next year, he added. And initial jobless claims came in lower than expected. It came in at 209,000, down 24,000 from the previous week, and the print is also 20,000 less than consensus. So we were expecting 229,000 initial jobless claims, and this data serves as another indication that the US economy is resilient despite higher rates. So consumer sentiment is up, jobless claims is down, and earnings remain strong. According to data from LSEG, earnings are expected to rise about 11.2% in 2024, and this puts the forward 12-month PE ratio at 19.1, which is well above the long-term average of 16. So stocks are looking a bit expensive right now, and we do need to see if these earnings materialize. But we do know that consumer sentiment has just ticked up. Jobless claims are moving lower. The US economy remains strong despite higher rates being at the highest level since 2006, 2005. But we do need to see if these earnings materialize, and if they do, it's going to be very, very good for stock markets. But if they don't, it's not going to be that great. Now, what we have been seeing is profit estimate downgrades, and we've seen downgrades for the 9th straight week in terms of earnings revisions. I showed you guys this chart yesterday, and I did some research into it because it was very, very interesting stuff. And this is what I found. I found the seasonal data for the earnings revision breadth, and normally November, December is the worst period for S&P 500 earnings revisions. As far as I'm concerned, earnings revision breadth is still well within consensus range, and as it stands right now, we can expect 11% growth into 2024. Now let's talk about seasonality. This is the chart we've been looking at for the better part of the last month. We said we expect a strong early November. We got that. Some form of a dip to come around this period, and then a strong end to November. And well, we haven't really seen the dip we are expecting. We're sort of just seeing indices chug higher through to the end of November. And I have some more stats here for you guys. The Santa Claus effect. So this is the Tuesday before Thanksgiving to the second day of the new year. And this is what the S&P 500 normally returns on average. You're looking at a 2.5% return, 58 wins, 15 losses. That's an 80% win rate for an average win of 3.78% and an average loss of 2.13%. The risk to reward right there is very, very good, especially in the Russell. 34 wins, 10 losses, average return of close to 5%, average loss 2.89%. So if you are playing the Santa Claus rally and you did buy at the lows that I said you should buy, we're going to keep holding, because according to the stats right here, we are expecting significantly more gains in both the S&P 500 and the Russell 2000, which is just going to further add to the positive breadth we see. And that's what strong rallies are built on. Strong rallies are built on strong breadth. Let's have a look at Gamma. I put this on Twitter yesterday, guys. So I said 4537 is a key level. Any action, any price action above 4550, we'll see 4600. come very, very quickly. If not 4600 today, then Friday, and if not Friday, next week. Either way, we creep higher and higher. There's way too much positive gamma for bears to do anything significant, and that was the price, and we're up about half a percentage point since then, and that's all we did. Now, I posted this well before market open, and what we really did was just creep a little bit higher, but we are sitting in this very deep and dense gamma zone. There are some risks ahead, guys. If we get below this level right here, just above the 4500, there's actually not a lot of gamma to support there, and there's actually some negative gamma strikes in this area. So if we do get to the 4500 into this negative gamma position right here, we could see quite a significant sell to about, you know, this level right here, but we do have to get through this huge amount of gamma, and we are in a positive gamma environment. So I think bears don't make the push by Friday when it's going to be extremely low volume on a half day. I think we're going to be looking really good to touch 4600 next week. Let's hop on the charts and have a look. And this is the year-to-date chart of the SPY. Zooming into the candle we had today, we did gap up on the day, so we gapped up from here to here. Then after we gapped up, we just had a massive push and pull between the bears as to where we closed, and we closed pretty much on the open of the gap. Bulls won in the fact that we actually just gapped up and stayed within this range. Breaking it down further into the hourly chart, and it was very indecisive. Bears did try to make a move, so too did bulls, but I just think there wasn't enough buyers or sellers in terms of volume to do anything significant. There are quite a number of gaps on the SPY here, but I don't think gaps always need to be filled. I highly doubt we're going to fill these gaps this year. The trend is up. Don't fight the trend, especially as we keep touching newer monthly highs, and we're breaking above the highs we seen in September and getting very close to the highs we saw in late July, early August. But if you've made it up until this far in the video, guys, thank you so much for watching. Please subscribe, leave a comment, hit the notification bell. You know I love you guys.